Welcome once again. This is Pinnacle Professional College, and today I'll be bringing you an exciting lecture on agency costs. In our previous lecture, we talked about agency costs. We talked about the fact that agency costs are basically the costs that shareholders have to incur as a result of contracting managers or directors to act on their behalf in terms of running the company. Now, there are three aspects to agency costs. There are three aspects. Number one is the monitoring costs. Number two is called the bonding costs. And number three is called, I would explain it more as the cost incurred as a result of managers not acting in the best interest of shareholders. So let me explain. Now, let's take the first one. They include the cost of monitoring, right? The owners of a company can establish systems for monitoring the actions and performance of management. They can establish systems for monitoring the actions and performance of management to try to ensure that management are acting in their best interest. An example of monitoring is the requirement for the directors to present an annual report. The whole thing around annual reports is a way to monitor the activities of management. These accounts are audited, and the auditors present a report to the shareholders. Preparing accounts and having them audited has a cost. It has a cost. So monitoring costs is one. Number two, agency costs also include the cost to the shareholder that arise when the managers take decisions that are not in the best interest of shareholders. So let's give a typical example. For example, agency costs arise when the company's director decides to acquire a new subsidiary and pay more for the acquisition than it's worth. The managers will gain personally from the enhanced status of managing a larger group of companies. The cost to the shareholders comes from the fall in the share price that will result from paying too much for the acquisition. Let me explain this. So let's say a company decides to venture into the acquisition of another company, right? And decides to acquire a new subsidiary. Now, what directors might do that might be in their own selfish interest is to pay more for the acquisition than it's actually worth. Why would they do so? It enhances their status. It will look as if they are managing a large group of companies, right? Because it sounds nice to say, I manage a subsidiary. You know, we've acquired a new subsidiary that is worth $500 billion compared to $500 million, you know. It enhances the status of the directors. But the cost to the shareholders would be that the share price would fall because the valuation of that new subsidiary was incorrect because managers paid higher than that they were supposed to. They did not pay the actual worth of the new subsidiary. So that's a cost that is related to the fact that managers were not acting in the best interest of shareholders. The third aspect of agency costs is costs that might be incurred to provide incentives to managers to act in the best interest of the shareholders. And this is what we refer to as bonding costs. And bonding costs the whole aim of bonding costs are to reduce the size of the agency problem. All right? So this is where you see incentives being given in the form of free shares, share options, etc. Another way that you see companies reduce the size of the agency problem is paying managers cash bonuses if the company achieves certain targets. You know, so the remuneration packages for directors and senior managers are an important element of agency costs. These are costs. These are costs. So number one is what? The cost of monitoring. Number two, bonding cost. Number three, costs as a result of managers not acting in the best interest of shareholders. This is very, very important. Very, very important. Now let's summarize all what we've talked about so far. Let's summarize all what we've talked about so far. So agency costs can be summarized as follows. Number one is monitoring costs, which is the cost of measuring, observing, and controlling the behavior of management. Some costs are imposed by law, and some arise from compliance with codes of corporate governance. Number two is bonding costs, cost of arrangements that help to align the interests of shareholders and managers. I explained this extensively, and that was enough explanation on the type of cost. They have residual loss. Losses occur for the owner, such as losses arising from a lower share price because management take decisions and actions that are not in the best interest of shareholders. So these are what we call residual loss, residual losses. Now, the main question on the table right now is, how do we reduce the agency problem? How do we reduce the agency problem? It's very, very key. Jensen and Macklin argue that when they act in the interest of the shareholders, managers bear the entire cost of failing to pursue goals that are in their own best interests. Jensen and Macklin argue that when they act in the interest of the shareholders, managers bear the entire cost of failing to pursue goals that are in their own best interest, but only a few of the benefits. So what does this mean? Or what is this heading towards? It means that incentives should therefore be provided to management to increase their willingness to take value maximizing decisions. Basically, what Jensen and Macklin is saying is that for managers to act in the best interest of shareholders, they have to be incentivized. They have to be incentivized. That's very, very interesting. They have to be incentivized so that they can take value maximizing decisions. In other words, to take decisions that benefit the shareholders by maximizing the value of their shares. Just think about it very, very carefully. Just think about it very, very carefully. So these shareholders, these managers have to be incentivized in order for their interest to align with that of shareholders. Now, there are several methods of reducing the agency problem. Several methods. Number one is devising a remuneration package for executive directors. And the remuneration package must be designed properly to achieve a mixture of both long-term targets and short-term targets. Number two, having a board of directors or a board that will monitor the decisions taken for the company by its executive management. So we can reduce the agency problem by having board of directors. The board of directors will monitor the decisions of the executive management. This is very, very key. Very, very key. Now let's move on to the providers of debt. The providers of debt or lenders. Jensen and Macklin argue that the problems of the agency relationship are bigger in companies that are profitable but have low growth in profits. So the problems of the agency relationship are bigger in companies that are profitable but have low growth in profits. These companies generate a large amount of free cash flow, What is free cash flow? Free cash flow is basically cash that can be spent at the discretion of management and does not have to be spent on essential items such as interest payments, etc. But typically, what you will see is that free cash flow should be invested in projects that will earn a high return, in projects that have a positive NPV, or be paid to shareholders as dividends. Now, you would see here that the directors and other senior managers of the company might want to invest free cash flow in projects that will increase the size of the company. These could be projects that will earn a high return. In a low growth company, however, it is likely that managers will want to invest in projects that increase the size of the company, but are only marginally profitable and will have a negative NPV. Now, one way of reducing this problem would be to have a high proportion of debt capital in the capital structure of the company. This is very interesting. Please pay attention very carefully. When when companies are profitable, when you have profitable companies, sometimes would have a large amount of free cash flow. And when there's a lot of free cash flow, this free cash flow can be spent at the discretion of management. And sometimes it's spent in such a way that is not in the interest of shareholders. Now, one way of reducing this problem is to have a high proportion of debt capital in the capital structure of the company. Now, interest must be paid on debt. And if interest is going to be paid on debt, this reduces the free cash flow. This reduces the free cash flow, and in essence will reduce the agency problem that we are talking about here. That's a very, very interesting way to think about it. And that's why when I was talking about the several methods of reducing the agency problem, one of the points is having a large proportion of debt on the long-term capital structure of the company. Right? Because especially for companies that have a large amount of free cash flow, there might be back and forth on how to spend that cash flow, and that cash flow might not be spent in the interest of shareholders. Therefore, for these particular type of companies, if they have a high amount of debt, then that free cash flow can be used to pay the interest on the debt. I hope that makes sense. All right, so this is where we'll bring our conversation for today. If you haven't subscribed to the channel, please do so, and share this video with your friends. Thank you for watching. Have a good day. Bye-bye.